This stock is literally trash and has recently become one of the most favorite stocks on Wall Street, trading at a little bit over $200. And in this video, we're gonna use some of the best known valuation models in the world to evaluate waste management and see if it's the right time to buy this stock. Also, I will give my personal opinion on this, so make sure to watch until the end. WM engages in the provision of environmental solutions to residential, commercial and industrial customers in the US and Canada. And thinking about this, you don't think about new, innovating or exciting stuff. You might also think there aren't many opportunities in the industry to really grow. But looking at the financials and its impressive growth in dividends, you might be in for a surprise on this. When evaluating companies, I not only use these valuation models, but also look at the latest earnings call, as this can also provide us with a bunch of useful information. There are some key things that caught my attention. What's important is that a company can keep growing its revenue year after year. WM grew its revenue by 5.7%. Another thing is that shareholders get something in return for investing into WM. That can give a return to shareholders in several ways, and two of the most known things are share repurchases and dividends. WM has returned 2.44 billion to shareholders, including 1.3 billion of share repurchases and 1.14 billion in cash dividends. What's important here is free cash flow. Remember that dividends are paid out of free cash flow, so only a steady and healthy growth in free cash flow can support a steady and healthy growth in dividends paid out. Free cash flow before investments in high return sustainability projects grew 5.1% to $2.67 billion. Not only I want to know about what happened last year, I also want to know about the future and its outlook on revenue growth and capital allocation. Total revenue is expected to grow between 6 and 7%. And here we can see the free cash flow distribution to capital allocation. First of all, waste management targets a 40 to 50% payout of free cash flow in dividends, which we will talk about later in this valuation model, paying out a total of $1.2 billion in dividends. Second, WM is also heavily focused on mergers and acquisitions, using billions of dollars to invest in high return sustainability growth investments. And third is share repurchases. In 2022, $1.5 billion were used to buy back shares. The last thing I want to mention before we move on to the actual valuation of the business is the increase in dividends, which us dividend investors love to hear about. The board of directors has indicated its intention to increase the annual dividend by 20 cents per share to $3, increasing the estimated annual dividends paid out to shareholders to $1.2 billion, and is an increase of almost 10%. So knowing all this, let's calculate the price of the stock using all these valuation models. But before we get into that, if you're new here, we tend to look at dividend stocks, bringing us a juicy cash flow, building our stock portfolio to the point where you might actually be able to live off your dividends. So if you're interested in investing like the rest of us, hit that thumbs up button so we can hit 69,000 likes. Or maybe just 6 likes? The first model we will take a look at is the discounted cash flow model. This method predicts the future free cash flows and calculates the present value, giving us the stock price. Putting in the historical free cash flow, we can make a prediction with a perpetual growth rate of 4.5%. Now that we have the future free cash flows right here, we add them all together. By adding up all the cash and cash equivalents and subtracting the total debt, we find the equity value. Dividing this by the total amounts of shares outstanding, giving us the price per share of $183.53 based on this DCF method. Not only do I want to know about the future of the cash flows, I want to know if the dividends paid out are sustainable. We need to put the dividends per share next to the free cash flow per share and see how these two relate, because dividends are paid out of free cash flow. Combining the two, we can see that the free cash flow is well above the dividends per share. By dividing the dividends by the free cash flow, we get the free cash flow ratio, which we want as low as possible. Over the past decade, it has been between 40 and 60%. This is an indication to me that the dividends paid out are very healthy and sustainable and allows the company to reinvest into the business itself as well. Next up is the dividend discount model. This model uses future dividend payments discounted back to its present value in order to determine the value of the company. We plug in the historical dividend payouts, giving us an average growth of 8.56%. Using a discount rate of 8% and a growth rate of 6.5%, we can calculate the stock price, giving us a price of just shy of $200, $198.80. The third valuation model we will use is the multiples valuation model, which assumes that similar companies should be valued the same. Companies that are similar are Clean Harbors, Waste Connections, and Republic Services. Plugging in their stock price and EPS gives us a PE ratio. We use the average and also the earnings per share of Waste Management in order to calculate the stock price, coming to $227.24. I don't just want to evaluate WM using other companies, but also comparing WM itself to its history. So let's take it a step further. I want to know how the PE ratio has been doing over the past decade. The thought behind the PE is as follows. Price to earnings ratio tells an investor how much he's willing to pay for every dollar of earnings of the company. So with a PE of 34.98 in 2023, an investor is willing to pay $34.98 for every dollar the company earns. So the lower the PE, the better. And looking at this chart, it seems that the PE is at a very healthy point and growing over time. So after using all these calculations and knowing all about the latest earnings report, we come to an intrinsic value of $203.19, which is close to the current price of WM. But after using a margin of safety suggested by the great Benjamin Graham, we can see that using a margin of 10%, our acceptable buying price is $182.87, which is below the current price. To me, this stock might be a great add to the portfolio, but I'd rather wait a bit for the stock to fall. As we can see, it has skyrocketed lately. So before you decide to buy in or not, please do your own research and let me know in the comments down below what you think of the stock. If you made it this far into the video, please consider subscribing to the channel. Thank you so much for watching and I'll see you in the next video.